the spread is like, if the risk-free rate is 400 basis points, and that's like a 6%, 600 basis point credit spread, I've extracted a 600 basis point spread for the next month in US dollars.
Right.
Maybe I 5x over collateralize it. Maybe I 10x. If I, raw Bitcoin is like 1-to-1. It's like, if I have $1 of Bitcoin, I have $1 of Bitcoin. If Bitcoin trades down 50%, I've lost half my money. But if I 10x over collateralize something, I have $10 of Bitcoin, I have $1 of stretch. If Bitcoin trades down 50%, I still got $1 of stretch. If Bitcoin trades down 90%, I still have $1 of stretch. The statistical odds of Bitcoin trading down 90% are like point something, right? It's a small percentage. So
Bitcoin's wild volatility may rattle markets, but for visionary builders, it's not a flaw. It's the foundation for a new era of digital credit innovation. Michael Saylor, a visionary entrepreneur and one of the most prominent Bitcoin advocates, continues to shape the narrative around Bitcoin as more than just a speculative asset. With Bitcoin recently dipping to $109,800, he emphasizes its deeper financial potential, serving as a foundation for creating digital credit instruments. By using overcollateralization strategies, such as backing $1 of credit with $10 of Bitcoin, companies can build stable credit products that remain secure even during significant price drops. Saylor highlights different investor-focused instruments like Strife for high-yield seekers, Stride for investment-grade exposure, and Stretch for low volatility, short-term yield similar to Treasury products. However, Bitcoin's volatility remains a critical factor. Its price swings are roughly 10 times more volatile than major currency pairs like the US dollar against the euro or yen. This extreme volatility limits its effectiveness as a medium of exchange and reduces its potential as a stable portfolio diversifier. Yet, Saylor sees this volatility as an engineering challenge rather than a deal breaker. Through structured credit instruments and over-collateralization, Bitcoin can evolve from a volatile asset into a powerful backbone for modern financial products, offering flexible yields and tailored risk profiles to a diverse range of investors. Bitcoin's financial revolution is just getting started. Drop your thoughts in the comments, share this with your network, and don't forget to like and subscribe to stay ahead of the next big move.
why did you sell $1 billion of Stride? So I could sell $10 billion more of Stride. Why did you sell $1 billion of Strife? So I could sell $10 billion more of Strife. So we have a very different business model in that regard. We created the Stride so we could create the credit spread because we literally wanted to have an investment grade type instrument, a senior one, and we wanted to have a junior one because there's one class of investors that want the junk credit, like they want 12% yield, right? So like, it's very simple. Do you trust the company? Do you want 12.5%? Do you half trust the company and you prefer to take the 9%? Well, there's markets for both, and they are not the same investor.
Yeah.
There are days when everybody wants to buy Strife and they don't want Stride, and there are other days when they want to buy Stride. And so that was part of building out the risk curve. And then the last thing we did, Stretch, was a very different idea. Instead of paying an 8 or 10% perpetual dividend forever, we just said, hey, let's actually reduce this to 1 month duration, right? And so we're only promising to pay this dividend for a month. The other one is a promise for 100 years. And so theoretically, the Macaulay duration, the theoretical duration on the other instruments ends up being between 8 and 20 years or 8 and 15 years. It's very long range. Think of a lever that's 120 months to 240 months long, and you have a little change in interest rates, and that's a very big lever to the good or bad. But with Stretch, the idea was a 1 month duration. Of course, inherently, that's going to be less volatile. Right. And you're like, well, I'm not going to get capital appreciation. If SOFR dives by 400 basis points, I'm not going to double my money. Well, exactly. It's a Treasury instrument. You're not buying it to double your money. If you wanted to double your money, if SOFR dives, you would buy Strife. Right? That's the instrument for the credit investor that wants to actually ride it up when interest rates fall or wants to do the opposite when interest rates rise. That's a different instrument. It turns out that most people, right, corporate treasurers, retirees, retail, most people, they're not really interested in being long duration credit investors.
Yeah.
Like ask the average person, do you have a bank account? Yes. Do you have a 30-year uh, Treasury bond. No, like the difference is like 50 to 1. Stretch came last, but ironically, Stretch is the best piece of financial engineering, and it's probably the most universally applicable product because what you're doing is just giving people pure currency cash flow, pure currency yield without the volatility, the risk, the duration, or the delta. It's like, you know, some people want delta. Like I want 30 or 40% of the upside of the common stock. Other people don't. Other people are like, I want nothing to do with the common stock. I just want you to pay me 10% on my money until I ask for my money back, right? That's what they want. It's a very different financial instrument for a different investor. And so now you have digital credit, you have digital gold, you have Bitcoin. Bitcoin is digital gold, digital capital. The killer use case of digital gold is issue digital credit instruments. And the aha moment is any company, any publicly traded company can create a digital credit instrument with any degree of yield, duration, delta, or risk. And to a certain degree with any amount of volatility that they want. Right? If you want extremely low volatility, you can't create a lot of it. Like if you have $100 billion of capital, can you create $100 billion of credit that's low volatility? No. But, you know, the real interesting question for all of us in the industry is, can I create $10 billion of low volatility credit with $100 billion in capital?
Yeah.
Or do I need 100x? Can I only create I'm sure I can create $1 billion of very, very low volatility. At 100 times over-collateralization, you'll certainly get it done. With 10x over-collateralization, I think you'll probably also get it done. At what level, 5x, 3x, 2, at what level can you not? And of course, that's a function of the Bitcoin volatility too, because the less volatile Bitcoin gets, the easier it is to create these low volatility credit instruments.
Bitcoin may not have fulfilled its promise as digital cash, but visionaries are turning its volatility into the backbone of a new era in global credit markets. Michael Saylor, one of the most influential voices in the Bitcoin ecosystem, is reshaping how digital assets can power modern finance. He outlines how Bitcoin-backed credit instruments can be tailored with different volatility profiles to match diverse investor needs. Senior instruments like Strife and Stretch trade around 10 vol, junior instruments around 20, Strike around 27, and equity around 50, creating a clear spectrum of risk and return. Saylor urges Bitcoin Treasury companies to raise maximum capital, accumulate Bitcoin, and avoid senior or secured debt. Rather than using convertible bonds that can pressure equity, he favors issuing equity directly and utilizing preferred credit instruments to preserve financial flexibility. His optimal structure involves raising $1 billion, acquiring Bitcoin, and issuing $200 million in stretch-like credit products, combining high-performance equity with stable, low-volatility yields. Unlike a Bitcoin ETF, a Treasury company can issue digital credit, offering bank-like returns without direct crypto exposure. Yet, Bitcoin's path is debated. Critics argue it has failed as a currency, labeling it speculative with no intrinsic value. Supporters counter that its fixed supply and emerging role in credit markets may redefine global financial structures. Let's get back to the interview.
You can see how they all trade. You can see the way the volatility profiles come off them. Like, for example, the senior credit instrument Strife is traded to a 10 vol. Stretch traded to about a 10 vol. The junior instrument is more like a 20 vol. Strike is more like a 27 vol. The equity is more like a 50 vol or something. So you can actually see that. You can see the demand in each one of them. You can see the liquidity profile. They all do serve different investor bases, so I don't regret having any of them out there. We will let the market decide what their appetite is for each of the four. I would say, you know, in terms of plan, what we know is we won't focus on convertible bonds or straight bonds, junk bonds, unsecured bonds. We won't do that. We will gradually equitize our convertible bonds as they come due. And then if I were giving advice to a new digital asset company, a new Bitcoin treasury company, if you will, I would say you want to raise as much capital as you can. You want to buy as much Bitcoin as you can. You don't really want to have senior debt You don't want to have debt that has a lien on the Bitcoin. You know, you in the ideal world, you might do a convertible bond, but you don't. But it's not clear to me that you should. If someone wanted to buy a convertible bond from you while you're private, if they showed up with $200 million in cash and said, "I'll give you $200 million and I don't want the equity, but I want a bond with conversion right and a 35% premium," I might take that money. That's not unreasonable. Having said that, if you're already trading in the aftermarket, the reason to do a convertible bond is you want to raise a lot of capital in a hurry. But the way you're going to raise the capital is the person that buys the bond is going to sell that much of your equity in 4 hours. Right. So if you sell a $200 million bond, you're probably going to create $150 million of selling pressure on the equity that day. And then the question you'd have to ask yourself is, why don't you just sell the equity yourself, right? And so a lot of times people that have the convertible bond, they don't have an ATM. Right. So if you're crippled because you don't have an ATM, the convertible bond is the de facto, tri-party ATM, right. But you pay a price, right? You might as well just dump $200 million of your own stock on the market, not owe anybody.
Right.
The stock will take a hit.
Because they're going to do it anyway.
The stock will take a hit, but if you do the convert, the stock will take a hit, but you'll still owe the money.
Right.
You see?
Yeah.
So I think that you could potentially skip that stage. And then, if you take the perfect structure, here's an ideal structure. You raise $1 billion, you buy Bitcoin, and then you go to the market and you sell $200 million worth of Treasury preferred credit instruments, Treasury preferred stock, like Stretch.
Yeah.
Like if you just wanted the simplest possible, the equity is high vol, high performance, high risk, and the credit is low vol.
So
right?
then you have two tools. You have the common
performance.
and the preferred.
Yeah, right. And the leverage for the equity comes from the preferred.
Right.
And the collateral, right? And for the preferred comes from the equity sale and from the Bitcoin capital.
Right.
A Bitcoin treasury company is in the unique position to create treasury credit, digital credit, right. Digital treasury credit. And people they're going to endlessly torture you and say, well, why should the equity trade at a premium? And the answer is because an operating company can create digital credit, an ETF cannot. And like, well, why would I, a lot of people are like, well, why would I just buy the Bitcoin? It's like, well, I'm not selling to to people that want Bitcoin. I'm selling to people that want 10% bank accounts.
Right.
Do you have a bank account that yields 10%?
No, but I want one.
Yeah. Well, why don't you just buy Bitcoin instead? And that basically tears apart the argument of the short sellers. Like the reason that people aren't going to buy Bitcoin is they don't want Bitcoin. What they want is a bank account that's high yield. In Switzerland, they want 10%, not 0%. In Japan, they want 8%, not 5%, nothing. In Europe, they want more than nothing, right? So the beauty of just focusing upon that, Mark, is it's such a simple story.
Bitcoin's volatile history, once viewed as a limitation, is increasingly being recognized as a structural advantage in modern finance. Its fixed supply and decentralized nature provide a resilient foundation for creating innovative credit instruments that can serve diverse investor needs. By leveraging overcollateralization, stable and flexible yield products can be built on top of Bitcoin, transforming it from a passive store of value into an active financial engine. These credit structures open doors for both high-yield seekers and risk-averse investors, bridging the gap between traditional finance and the digital asset economy. Rather than simply functioning as digital gold, Bitcoin is evolving into a critical infrastructure layer that could power the next generation of global credit markets. Could Bitcoin's volatility, once seen as a weakness, actually become the key driver in building the next generation of global credit markets? Bitcoin's financial revolution is just beginning. Share your thoughts in the comments, hit like, and subscribe to stay ahead of the next big move.